So we're going to start by looking at delta, and delta is the cumulative standard normal distribution of D1. Remember, these are formulas where I've assumed that we don't have any dividends, and also that the risk-free interest rate is 0. So this is just an approximation. The cumulative standard normal distribution of D1 is obtained from the Black-Scholes model, and we've already looked at it. And the formula is not the main thing here. What I want you to see is the visual representation of how delta changes as all the other parameters change. So to start with, how is the distribution of delta with different stock prices? So first of all, if you take remember the green one is the one that's the highest, and then the black one is in the middle, and the red one is the one that's the lowest. So the green one is going to be for stock prices that are really high. So think about a stock price that's trading around $800, for example, Tesla. And the black one would be a stock that's trading somewhere between $100 or in that range. And the red one is going to be a stock that's trading at a very low price. So for the ones that are very expensive, of course, those deltas are going to be more spread out, because every price here is going to represent, if you look at it as a proportion of the at the money price, is going to represent a very small portion. Because of this, those deltas are going to be spread out in a little bit. Those values are going to be spread out very wide. If the price is at a level that's less than the one that's very high, it's going to be something similar to the black line, which is not as spread out as the other ones. And the red one, for very low prices, is going to be a curve that's going to be very sharp and resembling the actual value at expiration, which is for options that are in the money. In this case, we're looking at, for example, a call. For options that are in the money, okay, like these ones they're going to have a delta of 1 at expiration, and the ones that are out of the money are going to have a delta of 0. So the price level determines the shape of the curve if we keep these strike prices constant. Okay. Now, how does delta change with implied volatility? Well, if you have a lot of implied volatility, those deltas are going to be more spread out. Why? Because these ones, if you see here, for example, at this strike price, or for example here, the ones that are out of the money, at this price, the one that has the most implied volatility has a certain probability of actually getting in the money, so the price going higher. So because of that, because the probability is higher for this one, the delta that's assigned to it, or the delta that's calculated for this one, is going to be higher. And because of this, the overall curve is going to be more spread out. If a certain underlying doesn't have a lot of implied volatility, it's something similar to this, the delta is going to be like this. And if your underlying doesn't have a lot of implied volatility, well, the only ones that are going to change are probably the prices, the strike prices that are very close to the at the money, because there's not a lot of implied volatility. Because of this, the curve here is going to have a very sharp angle, and it's going to again approach the actual value at expiration, which is 1 here and 0 here. Okay, so remember, at this point, we're seeing how changes in implied volatility affect the delta, and we're keeping everything else constant so that we can isolate the effect of implied volatility on delta. Now, how does delta change with time to expiration? Well, delta, as time starts passing, that if you have a lot of time, the graph is going to be like this. The curve is going to be spread out. As time starts passing and there's less and less time to expiration, you're going to see that line is going to start approaching the actual expiration line, which is going to be, like I said, a a very sharp line where it's 1 for everything that's in the money and 0 for everything that's out of the money. So when you have very little time, the delta is going to be 1 for most of these strikes, and then 0 for most of these strikes, and only these ones are going to have a certain delta or a meaningful value of delta, because those are the ones that can actually change. And those are the ones where you still don't know. This is where the uncertainty lies, here in this area. So this is how delta changes with time to expiration. So as you can see, delta, as the price changes, as implied volatility changes, and as time to expiration changes, delta also changes. And these are the Greeks that measure that. Gamma, we already know that, how the delta changes as the price changes. Vanna for implied volatility, and charm for time to expiration. Again, this is just a name. We don't need to calculate it, but we know now. Now you have a visual understanding of how delta changes as time to expiration changes. Finally, if we look at the distribution of delta, we have some formulas that we can use. We've already seen these formulas. The delta for the at the money, for an at the money call, is going to be equal to 0.5 plus 0.2 times the implied volatility times square root of time. We already see that. We've already seen this in a previous lesson, and it's going to be a value that's going to be very close to 0.50, but not exactly 0.50 for a call. Now, as you start to move by one straddle, if you go lower in price by one straddle, by two straddles, the delta can be approximated by using the delta of the at the money plus 30 as you move in the money, and by 45 if you move two straddles in the money. If you move one straddle out of the money, then it's going to have your delta that you calculated at the money minus 30. And then if you move by two straddles, you can approximate the delta by having the delta of the at the money straddle, or the delta of the at the money call in this case, for example, minus 45. Okay, so this is the distribution of delta. If we're not changing anything, if you're just looking at the delta of the at the money call, for example, and then you move by one straddle, you can take this delta and add 30 deltas, and you're going to get an approximation for this value of delta. And then if you move by two straddles, you're going to have the same delta of the at the money plus 45. If you move out of the money by one straddle, you just subtract 30 deltas. And if you move by two straddles, you subtract 45 deltas.